Please, Amit is going to end this talk for us. So, last year, accomplished value investor and fund manager Amit Wadhwaney came and addressed your seniors and left them wiser than they were before they met him. I have little doubt that today will be any different. Amit is not only a fabulous value investor, he is also a very dear friend whom I know for more than a decade now. Amit spent more than 20 years at Third Avenue Value, most of which was spent with Marty Whitman, whom I regard as one of the most original thinkers in value investing. Marty influenced a whole generation of value investors, including Amit and me, and through his letters and books, and his work will continue to inspire future generations of value investors. While at Third Avenue, Amit managed billions of dollars of clients' money and delivered a stellar track record. He recently left that firm to start his own firm called Morius, about which I sent you some material yesterday. Well, I was going through his firm's website and I came across the story behind Morius. And I quote, Morius' name is derived from classical Latin word describing a city's defensive walls, which were designed to protect both the city and its inhabitants from risks, both predicted and unforeseen. I could not help but smile when I read about Morius representing a city's defensive walls. Sounds a lot like that water body which protects a castle, doesn't it? I smiled because last year while introducing Amit, I had stated, Amit's style of value investing is quite distinct from mine. He focuses on net asset values, I focus on moats. Dear students, please welcome Amit.
Thank you, sir. Good afternoon, everybody. Do let me know if you cannot hear me, because that is often the case. It's often the problem. I tend to mumble. So, it's time, one of the things that I mentioned, I thought it'd be interesting to talk about risk. Risk is a very funny, sort of squishy idea. And I thought about, gosh, that looks stellar. Okay. So I thought, how should we think about a title for this? So the first name that really came up to me was risk, or how to lose a lot of money in a hurry. My partner thought it was a very flippant, foolish sort of idea, which is why I turned it to something more appropriate, like perspectives of risk. Something more sort of suitably mature. We thought it was a little foolish. So over the weekend, what was interesting, I came across an article, it's a book, a recent book written by someone called Jason Zwei, The Devil's Financial Dictionary. And in there, this is his definition of risk. The chance you don't know what you're doing when you think you do, the prerequisite for losing more money in a shorter period than you could have ever imagined possible. So it just sounded kind of like what I was saying before. How are you going to lose money in a hurry? And that's what risk means to me. Now, I will say right at the outset that risk is a very squishy concept. It's a very it means different things to different people. And for example, especially in the world of investments, people, for example, who run hedge funds, which purport to deliver steady rates of return market mutual funds, will measure risk by things like volatility. Or, for example, many academics, academics in the world of finance, tend to focus on risk and various sort of statistical measures of variability as the basis of risk. Well, that is not what we do at Moirus. And what I'm going to focus on is what we do at Moirus, because that's pretty much all I know. Doing all this stuff all these years, my skill set is just narrowed and narrowed and narrowed and narrowed, so I'm not good for much else. Let me talk about a few things I know a little bit about. Hopefully, it'll be interesting to you all. So, now, that worked. Okay. What is Moirus? Moirus, you have a definition of it. And we are long-term value investors. We are long-term value investors. second, so it's probably good. Okay, so the first line there is we talk about ourselves as being long-term value investors. Now, long-term in our way of thinking is probably at least 3 to 5 years. So anything you buy with the view of owning it for at least 3 to 5 years, hopefully more. I mean, it's not because we're lazy, because it takes a lot of work to find an interesting new idea. But there's a number of aspects to being long-term as an investor. One is, of course, from a taxable investor's perspective, it's called tax-free compounding. And if you get it right, you can actually get it quite well. So there's transaction costs are mitigated, taxation is mitigated. So long-term is actually not a bad idea. Then what about value investing? That's a big loaded word. Value investing, as I'm sure you've learned during the course of this term, means many things to many people. There's a great variety of what is considered value investing. Our approach, and I will say it very simply, without getting into nitty-gritty, is basically try to buy something at a valuation that is well below what somebody in that industry, knowledgeable investor, business owner, what have you, is going to pay cash for in an arm's length transaction. Okay, so it's a very cash transaction, it's to be non-distressed, non-hype transaction, so you cover the two ends of distribution, and what it is, it just gives you a sense of what something is going to be worth. And you want to do it conservatively. We'll get into matters of what we think of as conservative. Then we are bottom up. Now, that idea of bottom up in this context is the following. The investment approach focuses on company by company. That is our focus. So what we don't do, what we absolutely don't do, is we don't forecast things macroeconomic and say, well, the housing market is going to boom, therefore we buy lots of housing stocks. We don't do that. We're interested in buying individual securities cheaply, one by one. So it's entirely opportunistic. You go where the opportunity is, and we do it across industries and across geographies. Moeris is a global fund, so we can be in most parts of the world, subject to obviously a number of constraints. The constraints really being our investment discipline itself, but we will do stuff around the world. Now, because I mentioned we're macro-myopic, all I want to say there is we don't have enormous foresight. Macroeconomic variables, we can recite them, we can talk about them, but they're very hard to forecast again and again and again with reliability, accuracy, such that you would risk your money, and other people's money more importantly, on a macroeconomic forecast. So that's what I mean by macro-myopic. We're not far-sighted, we're very short-sighted. We know what's happening now. We have some idea what the current rate of inflation is, the interest rates are, that sort of stuff. Okay, so our knowledge is confined to relatively short term in factors macroeconomic. But we're macro-aware. Now there's a very big difference in between those two things. Macro-myopic means you're not forecasting, you don't really want to take the trouble to forecast, but macro-aware is you're a bottom-up investor, but you're aware of what factors macroeconomic will affect your business. How interest rate changes will affect your business, exchange rates will affect your business, inflation rates will affect your business, a whole bunch of things that will affect your business. And this will dictate what we do and what we don't do. Okay, so you will try to insulate your individual investments from things that are adverse, that have a likelihood of going against you in a macroeconomic manner. You're not making a forecast, but if it is your belief that there is a risk that interest rates are low and they might be going up, and the company that you own is highly exposed to interest rates, you would think twice before putting any money to work there. Okay, so that's how we think about our macro awareness. Risk aversion. Now this is where it starts to get the first sort of we start to get into our first exposure of how we think about risk. What we try to do is buy businesses. We don't think of these as pieces of paper that go up and down, because they do go up and down, but really the risk that we are very interested in is risk associated with owning a given business. Remember, any investment decision is of the following story. Here's a pot of cash. You can sit in cash, do nothing with the cash, and you can invest it in something, a stock. This is going to be variable. The price can change from day to day, it can fluctuate. That's a fact of life, uncontrollable, so don't bother to think about that. But what you really want to start thinking about is what are the fundamental risks sitting inside the business? We will talk about that a bit more. We'll get to the nitty-gritty of both how we think of asset valuations and how we think of individual risks that attach to companies. The risk, I will say right at the outset, the risk that we're very, very focused on avoiding and identifying and avoiding is any risk which involves, if it actually comes to be, could hurt your company, hurt the business, diminish the value, make it bankrupt, or just permanently erode the value of the business. The idea is to buy businesses cheaply so that over time they build in value, and you as an investor will participate in that. Anything that causes the counter to that, the opposite of that, you want to make sure you do not have exposure to. The second thing there is really avoidance of business risk as well as at the portfolio level. We'll comment about that in a moment, but really it's an extension of individual risks that you're taking on or avoiding at the security level. A portfolio is a collection of securities. And how do you choose to take on risk at a portfolio level? And that's what we will touch upon in a minute. And then the last item is embrace market risk. Well, at the beginning I said, look, you have a choice when you invest. You have cash, the cash is turned into a security. You buy a stock or a bond, whatever you buy. This security fluctuates. It's fact of life, uncontrollable. How does this work in your favor? Rather than be anguished about the fact that this thing fluctuates in price, embrace it. It is a source of opportunity. Fluctuations can go both ways. Things can get very cheap sometimes for reasons which may or may not be economic or fundamentally defined. Should they be non-economic, something that's worth 5 suddenly becomes available for 2, you really should consider owning something like this. So think of market risk as a source of opportunity. Things get cheaper, you can buy more. Things that are expensive, you can sell them down. I mean, if that's what you want to do. But market risk is not what we consider risk from our investment perspective. Now we will, valuation. Now this is the start of the nitty-gritty. It either gets very dull or it gets very interesting. So, for us, and again, different people use different valuation methods. We tend to be, I think, somewhat outliers at one end of the distribution. We believe in buying things very cheaply. Now, very cheaply to us means cheaply in periods of despair, disaster, catastrophe, and so forth. So things have to be very cheap. So as long as things are not cheap, it will not cause us to stare to buy them, but it will probably, if things get interesting, they have to be very, very cheap for us to actually act on something. The size, how do you measure cheapness? So in the abstract, you measure what something is worth, and then you try to buy it at a discount to what it is worth. But how do you measure what something is worth? How you make the measurement is a function of the yardstick that you use. Your methodology, for example. Some people will use discounted cash flows. They will project future cash flows, discount them back to the present. Other people, such as us, think in terms of what's this company worth if it were to liquidate today, wind it today? If you could sell the pieces, pay off all the debt, and pay the shareholders, what is it worth under that scenario? Typically, most of the time, not necessarily, the second method tends to be much more conservative. In some ways, it may be slightly unrealistic in terms of what you can get in a business transaction. Because, some people some business buyers are not looking for carcasses. They're looking for living things, like real businesses, as in going concerns, not companies that are wound up and have closed down. So you can have very, very different outcomes. If you use one methodology, DCF, the discount cash flow methodology, you can have an extremely different outcome in terms of what you think the business is worth versus if you use the liquidation value. Let me give you a quick example of that. So a number of years ago, we were looking at a company in Sweden. The company in Sweden really was a securities brokerage firm, investment bank, and investment manager. So your standard multi-purpose brokerage firm, full service brokerage, investment banking, asset management firm. It was interesting to us because a number of people in that industry, it was a very bad year for the industry, a couple of very bad years that happened. People were closing their doors in the industry. And I said, well, that's interesting. Maybe we'll be able to get something cheaply there. Now, remember, here's this company that provides services to investors. They're basically stockbrokers, so of course they do much better if there's more activity in the market, which usually does better if the market's doing well. They also were a well-known investment banker, and of course, similarly, they too do well as the market does well. And finally, of course, investment managers, asset managers, they invest in other people's money. Of course, people like to give you money when markets are going up, not much less so if markets are going down. So here was a company whose fortunes were very much based upon the stock market. Okay? So how do you think about this? Well, you don't know the future, and which, by the way, is my first problem with the discounted cash flow approach, because you have to make an assumption about the future. So I was not willing to do that. So I said, okay, fine. What would this company be worth to me today if I was to have three pieces? I could get rid of the pieces. What would I get? What's it worth to me? So based upon our assumptions, and we can talk about them in more detail if you're interested in that, based upon my sort of assumptions, which were, I thought, pretty, some people would say harsh, some people would say unrealistic, but I thought, look, bad things happen, there's tough times, businesses can go under, and businesses can disappear. For example, they had an investment banking business which is ranked either one or two across the four different Scandinavian markets. Investment banking is a business which involves people. In this case, they did not use capital as part of the proprietary risk trading, so it was really people advisory services. The problem with people is they can walk out the office today and not return tomorrow. Basically, they're an asset that could evaporate on you. Obviously, most firms have reasons and ways that they contain these people, keep them in bad times, but that was a risk. So if this bear market in the Nordic countries went on for a long enough period, well, then many of these people will start to leave for greener pastures. They may open up restaurants, for example. Who knows what they do? They go to the other brokers, whatever. And they were clearly very talented people. So we valued that business at zero, which of course, arguably, people would say that's a crazy assumption. Well, bad times can happen. And I've seen bad times. Japan had a bear market that went on for well over a decade. So you could have some fairly unpleasant outcomes, so you prepare for them. So we made very conservative assumptions, and so we came up with a valuation for this business of about, let's say, I think it was about 35 Swedish kronor per share. 35, 40, let's say 40 Swedish kronor per share. So the game plan we had was, okay, this thing goes down, so in the 30s, low 30s, we will start to buy. Remember, this is a liquidation analysis. Company goes out of business, what can we sell the pieces for? Fast forward. A brokerage firm, and brokers have a bias of being generally cheerful people. They think good things are happening. At least if you can convince your clients good things are happening, they're going to buy stocks from you. So being positive and cheerful is a very important tool in being a broker. Should you all be, if you are considering doing something like that, you've got to be cheerful. So the brokerage firm in question, it's a fine brokerage firm. It's not intended as a particular brokerage firm. But what they came up with was a slightly different view of the world. They, unlike I, had a good crystal ball. Their crystal ball could allow them to see the future, and what they saw was 2003, or 2002 really, was the bottom of the bear market. 2003 would be a better year, 2004 would be better yet, and so forth. So using this as the sort of basis of their assumptions for projecting cash flows, they, of course, generated very good-looking numbers for this company. And so, of course, there are these great cash flows going from 2002, which is the bottom, to the next 5, 6, 7, 8 years. And they proceeded to come up with a valuation, a DCF valuation of, I think it was 130 Swedish kronor per share. So my valuation is at 40 Swedish kronor, their valuation is 130. How you pick your methodology, well, the methodology you pick, the assumptions you make, will really have a bearing on the number that you get as your net asset value, which in turn will determine what you buy and what you don't buy. It's as simple as that. That's issue number one. Okay, so it's a function of valuation methodology employed and the assumptions. The second item there says not all discounts are equal. What do I mean by that? Specifically, let's say we use a consistent methodology. Is a 45%, if you're getting the option to buy two things, stock A is at a 45% discount to its net asset value, sounds very good. Stock B is at a 25% discount to net asset value. Which one would one buy? Now, it's not just a buying by numbers, it is also should reflect the decision process should also reflect the quality of the business, the nature of the business, the nature of the industry. So sometimes it is possible that something that's at a 25% discount to NAV is probably a much more interesting purchase than something that's a 45%. Well, for example, you can think of two distinct industries. Industry A, a 45% discount, is fragmented, highly capital intensive, highly cyclical. Industry B, capital light, consolidation is always done, and in general cash generative. So clearly, to the extent you're able to buy these 75-cent dollars industry B using a very conservative methodology, it may be worthwhile to think about that as a potential purchase. So again, not all discounts are equal. Some element of judgment is needed. It's not all buy by the numbers. Okay, so the computer is not doing this for you. A human being is, and there's a subjective decision-making process that's going on there as well. Now, the third item, the assumptions should be based on minimal guesses about the future. Well, as I mentioned, I have an aversion, I have an allergy to making guesses about what happens in the future. So, clearly, the decision-making is based upon what you know here and now. Because of that, the kinds of things that you will assume are things you know today, and about the company itself, the kinds of things you do know at a given point in time, earnings until this point in time, but you also have the balance sheet. So from our perspective, the thing that's most interesting is usually the balance sheet. It's not that we reject or neglect or ignore the income statement. It's usually the balance sheet that tends to be the financial statement that's the most useful to us. Not just it quantifies the various resources that the company has on its balance sheet, the liabilities that it has on the balance sheet, also the quality of the resources. Everything else being equal in hard times, a liquid asset is probably a bit more useful than an illiquid, unsaleable asset where there's not a market. Okay, so balance sheets also have to be viewed in there's a softer qualitative side to looking at balance sheets as well. But clearly, the balance sheet, the right-hand side, absolutely has to be thought about fairly carefully. The next item there is for a methodology that yields bedrock valuations. This is what I mean by the preference is for a methodology that's a very conservative one. Okay, so what you want to be able to say, at least to convince yourself that this is worth 45 Swedish kronor a share, I bought 35, and the 45 is a good number. The reason I say that is because what people are willing to pay often varies. It varies financing ability. For example, sometimes transactions do not happen, purchases do not happen because financing is not there. People usually will borrow some money or raise equity capital. They'll need external financing to make an acquisition, purchase something. Financing is not available. So what you do want to have as a part of your valuation methodology, that be robust under all sorts of conditions. Conditions when financial markets are conducive and conditions when financial markets are hostile. Because over time, you will encounter periods where times are difficult, and you will wonder, is this something worth buying? What's it worth in an environment like that? So the answer would actually vary if your methodology was variable based on the availability of financing. What you want is something that's bedrock, that doesn't really change because of the nature of the market. So, jumping to the last item. So the first and foremost thing, and this is probably going to sound very foolish, but it's actually less foolish than it is. The first way of avoiding risk is buy cheaply. Now, again, this is a function of your investment discipline, but buy as cheaply as you can within the context of your investment discipline. Now, people often say that You bought cheaply, therefore you have a margin of safety. I am not so sure that's an entirely accurate statement. Buying cheaply is a necessary but not a sufficient condition for having an appropriate margin of safety. A margin of safety is that which protects you against permanent capital loss. Buying cheaply is a part of it. Buying cheaply in isolation does not in any way prevent loss of 100% of your capital. You can lose all your money. Something can go wrong with a cheap stock, and of course, you will lose all your money. So it's a good starting point. In fact, it's a great starting point. However, it is not the only thing that you need to do. So, it's not as simple as it looks. That's probably true. It reduces price risk, but that's largely what we spoke about a minute ago. But the one important thing, in addition to buying cheaply, is to think of what else there is. All the other risk factors that attach. Okay, so the one thing buying cheaply does, it reduces your price risk. But price risk is only one of the things. And the other thing I will say about buying cheaply, I was saying that I subscribe to, you make 2/3 of your money when you buy. The rest, you make much less when you sell. That's going to sound strange because if you buy things correctly and you buy them really well, you will have something that over time can appreciate enormously if you've done your homework correctly. Selling is a bit more of an art. Buying correctly is a much more disciplined activity. And if you accomplish that correctly, it does a lot of things. In addition to reducing price risk, it also sets you up for interesting potential compounding. So let's start talking about the other risk factors. Generically, what I'd like to do, I'd like to think about this as 3 parts. Factors that are internal to the business, the risks that you're taking that are internal to the business that can hurt you. Factors that are external to the business. And the last one is there's a whole basket of other considerations. Okay, so let's tackle this. So the first thing is, of course, balance sheet. Well, we're very focused on the here and now, and this is all you know about it. And the company tomorrow and the after tomorrow can change a lot. What do you know now that will allow you to make a reasoned investment decision? And the first thing there that you have, the first statement that you have in front of you is a balance sheet. The balance sheet has to be looked at, as I mentioned before, the assets, the resources, how liquid the balance sheet is, and so forth. You should also look at the debt. And this is where it gets a little bit more subtle. In that, debt can come in various shapes and forms. Debts at different maturities, different terms. Debt can be recourse, non-recourse. Let me give you one of these great sort of misnomers. So I've heard so many times from people saying, well, look, here's a company. If you consolidate the financials, it looks highly leveraged. But the debt is held at the subsidiaries and it is non-recourse to the parent. And that is used as an argument for saying, well, this company is not really leveraged, the subsidiaries are leveraged. The problem with that reasoning is the following. Sometimes, when you have non-recourse debt, and the company's principal assets are basically holdings, ownership positions and stakes in these entities, if one or more of these things goes under because of its highly leveraged nature, you have a meaningful elimination of value. So the debt structure should also be looked at in the context of how it is organized, where the debt is, whether it's non-recourse or not. I mean, that obviously you have to think about that, but you clearly have to think in terms of debt in the aggregate as well as debt in where it is, the terms of the debt and so forth. So it's a bit more of an involved exercise than just looking at consolidated balance sheets and oh, this company's not leveraged or this company's leveraged. It's a bit more involved than that. Companies, of course, that do not have recurrent capital needs are more interesting than those that do. And obviously, when you do a business analysis and look at the company, clearly that's a risk that you should look at. Will the company, which has recurrent capital needs, will it be able to finance itself? So that's something that you should think about. Inept, dishonest management, or inept, self-serving, dishonest management, which are aided and abetted by directors. And I can give you a wonderful example of a company we used to own. So, value investing, companies that are asset rich, often invite crooks. People who are going to come, this company supports these assets as balance sheet. People all think, well, this is the well from which we're going to put all the water and drink the water ourselves. We won't give the shareholders anything. We won't give anything to the shareholders. Well, we had this company, I will absolutely not name it, which was, it's an Asian company. And the thing about the company was, it's an extremely asset-rich company. 3 or 4 large shareholders. And the company was made up of 2 kinds of assets. Okay? It's a holding company. More than 50% of the value of the company was 2 listed stocks. Listed in the marketplace, and more than 50% was these listed stocks. The remainder was a collection of very interesting businesses. Businesses that made money, didn't make money, but very asset-rich businesses. Companies, these individual other assets and businesses were things like, well, they were all, let's say, real estate-rich businesses in different parts of Southeast Asia and the United States. So it was an extremely inexpensive stock. Now, to us, the 2 listed companies, it made sense for them to either sell them, and because they were pretty easy to sell. I mean, one was listed in Asia, the other one listed on NASDAQ. Both could be sold, and you could reinvest that money in growing the other real estate businesses. The real estate business, the issue with them was they didn't have scale. They needed a bit more scale. You could run them more efficiently. So we, good-sized shareholders, along with a few others, approached the company and said, you guys should do this. Maybe. Anyway, the saga went on for many years. I mean, why is it they're not doing this? Presumably they own shares themselves. I mean, the management certainly did. Then it turned out that the CEO's compensation was based on the consolidated EBITDA of the company. Now, what does that mean? One of the publicly listed companies they owned was an operating company, a large company from an operating earnings perspective, EBITDA perspective. So in consolidation, whereas they saw none of this cash came up, it was sitting down there at the level of this company, this public company, separate company, but it was 57% owned, so it was consolidated. And as a result of that, the EBITDA numbers were actually quite outstanding. They were large numbers. And the CEO's compensation was based upon that. Unfortunately, the company itself, the actual company, did not make that much money. And of course, this person was basically taking it. Now, you obviously have to have a board that's complicit in this sort of behavior. And there were means by which the board was, shall we say, captured, and so you have to worry about this sort of stuff. It sometimes is not obvious and visible, and once you see non-intuitive behavior that is actually running counter to what you as a shareholder want, you should worry. So inept management, but again, aided and abetted by corrupt management, aided and abetted by the board is a very important thing. And the story actually had a happy ending. Both the CEO and much of the board was ejected by the shareholders, and it turned out to be actually quite a good investment with them taking over. Now, the other thing is governance. Governance sometimes, poor governance can stem from one or more groups of shareholders, sometimes very large controlling shareholders, and sometimes not such large shareholders, but enough that they can exert control. They could direct the company's resources to means that are not necessarily great for all the shareholders. So you've got to worry about that. And the last thing is absolutely important. I mean, this has saved me a lot of grief and misery over the years. Risks stemming from the business model. Business models determine outcomes, determine how the business is run, how the company is run. Is the company configured for good times? Is the company okay for bad times? For example, a business model I've really disliked over the years is a business model where companies acquire each other, keep acquiring each other. The problem with that is, of course, there's a business of acquisition, financing the acquisition, so they've got to go out and get cash all the time. And next of all, the accounting that goes with this. Because the accounting that usually accompanies successive sequential acquisitions, basically, how to put this, works to hiding the organic aspect of the business growth. Basically, all you do is you fill the numbers and you will generate or produce growth. And it just, unfortunately, It's just something that's very hard to decipher, even in the US, where you have a fair amount of disclosure about this sort of stuff. And usually you wind up, sort of serial acquirers, you can wind up with encountering some sort of hand grenade sitting in there that will blow up at the worst time. So that kind of business model is something I quite dislike. Another kind of business model, which can also be fatal, is a model that requires you to issue securities, financing, to have recurrent access to financing on the outside market. Now, what do I mean by that? So, suppose, for example, you're a big brokerage firm, a big financial firm, investment banking firm. You will go there. You need to be able to finance your holdings, your inventories, your securities, and so on and so forth. So you go out and you issue, in the old days we used to go commercial paper, short-term paper, you issue paper. And to do that, to be able to do it on a heartbeat, you have to have a rating, and a high rating. Now, the problem is, if you don't have the rating, you can't do it. So visualize the following circumstance. You have this inventory that you have to keep on your balance sheet. You have to keep rolling over this debt issue. So you go to the market, $100 million. Another couple of days, another $100 million. So stuff matures, and matures quite fast. But you have to have a credit rating. So the question one asks is, someday, the debt rating agency decides that something is going wrong here, and they decide to withdraw your debt rating, lower you. Suddenly people say, oh no, I can't buy this paper. This is not the paper I'm permitted to buy, and I will not buy the paper. The company's gone from low risk to high risk. They may not pay me back when the money is due. I will not buy the paper. Suddenly, the issuer is out of luck. The issuer basically is unable to issue the paper and is unable to, as a result, support inventory. Companies blow up. That, by the way, folks, is a story behind Lehman Brothers and Bear Stearns. So, worrying about that kind of business model and avoiding those kinds of business models, businesses that require recurrent access to capital markets, either purposes of acquisition or just the daily running of the business, business models one wants to avoid. Because there's a lot of risk in those business models. Sometimes there is a risk. It doesn't happen all the time, but you plan for the bad times. The bad times are what you want to avoid. Everybody is just fine in good times. It's the bad times that are going to differentiate how one does versus one's peers. Let's talk about external, outside the company. What kinds of factors outside the company can hurt your investment? The first thing is government involvement, either official or by suasion. Official, is the government comes and has a big hammer on your head. So, two small stories. Years ago, after the telecom bust, there was a big TMT bubble. Any business that had one T or an M or a T in front of it could issue debt, equity, and stupid terms. People did silly things. So there's a little country out there, the other end of the world, called New Zealand, which has got less than 6 million people living there. They had, probably 4 or 5 telecom providers. Now, the thing about these telecom providers was 3 of the 5 were not making any money. So they had to come to the market, issue paper, and issue paper, and issue paper. So they made a loss, they went to the market and dropped that loss. You lost 5 million, you bought 5 million, or you got 5 million equity. Now clearly, that's a stupid way to run a business. But look, you had this, the markets were compliant, it worked. It worked for a while, and then, starting March 2000, this bubble started deflating. Bit by bit, people said, why do you give these people money? They never make money, they're never going to make money. So bit by bit, 3 of the 5 disappeared, so they were left with 2 pairs, a duopoly. There was a duopoly in the fixed line side, there was a duopoly on the cell phone side, the mobile side. Which, of course, we like that sort of thing. We like those kind of businesses because it's a small country. It's not a vigorously growing economy, vigorously in terms of population users. I mean, it's wealthy and getting wealthier, but it's not a vigorously growing economy in terms of population. So you didn't think that somebody else would come in and make the huge investments necessary in infrastructure. So we bought a company called New Zealand Telecom, which was the big incumbent. They had a gold-plated infrastructure. They spent lots and lots and lots of money, and of course, they were the big player. New Zealand Telecom started making lots of money. Lots of money. The dividend went up. They bought back shares. They had returns of capital. All kinds of great things happened. We were happy shareholders. Suddenly, one day, out of the blue, and this is in New Zealand, a country which is historically known for reasonable governance, reasonable government oversight, and reasonably friendly government, friendly in terms of business. The then Prime Minister, someone called Helen Clark, was getting very unpopular. She decided the time had come to win popularity back. And what better way to win popularity back than by putting your hand in the pocket of one of the public companies? Because most of the shareholders in New Zealand Telecom were foreigners, and if we, the foreigners, could not vote in the next election, she said, all the farmers are going to have broadband on the same cost, same terms as city people. Think about what a crazy idea that is. New Zealand has lots of farms, okay? Lots of farmers, and farmers live scattered across the country. And to construct and erect infrastructure is extremely expensive. So suddenly, New Zealand Telecom, from being an overcapitalized cash-generated business, now has enormous capital spending in front of it. Of course, needless to say, we fled our investment. It was a profitable investment, but not as much as what we would have liked. Another example, also in another country which is known for, I think, fair play and decent treatment of investors, Norway. Norway has a very large shipping sector. You know, shipping in Norway has had at the point in time, certain tax attributes, good tax attributes. They decided that they would bring in the tax regime in line with Europe, which was not a bad thing. However, the problem is the Norwegian government would have to forego all kinds of tax revenues. So they said, we will go to that tax regime, but the last 5 years of taxes that you would have paid if you were in this other regime, give them to us. So over X years, you will have X years to discharge this obligation. So suddenly, on the balance sheet of these shipping companies operate with a fair amount of debt on the balance sheet. Ships are highly capital-intensive businesses. It's not a great business, it's highly cyclical in many cases. So suddenly, on these companies, this huge liability appears. Basically, what happened was, so you look at the right-hand side of the balance sheet, okay? You have debt and shareholders' equity and other liabilities, okay? So suddenly, what happens is this huge new liability appears. The shareholders' equity is sliced off to that same extent. Suddenly, your debt-to-equity ratio just goes vertically up. Many of these companies basically were in violation of the debt covenants. The debt has to be renegotiated, and it was a disastrous situation. So, otherwise, normal governments can behave peculiarly and to your detriment. Visualize, and these are of course governments in affluent countries and countries which are known for fair play, visualize doing something with an industry that's sensitive. An industry that sort of tackles a necessity. Pharmaceuticals, food, and those sorts of things. Again, depending on the country, you can have terrible consequences. Here, for example, one very quick example about that. For a number of years, I used to visit a company in South America, in Colombia. It used to be called Nacional de Chocolates. Basically, it's a food company. They made initial chocolates, which is what the name suggests. They made things like sausages, they made cookies, crackers, biscuits, and they made all across the entire food net spectrum. They also had what was in the early years, I mean this goes back to 2004, which is the first time I visited them, a very nice little business in Venezuela. Now Venezuela, as you may, if you observe that part of the world, has been ruled by a collection of, what's the word? I don't want to say dictators, because they're not dictators. But they're demagogues, they're sort of very populist leaders. That's like, we're populist leaders. Now, these populist leaders have decided what is needed, necessary for the people, and we will basically expropriate your assets. So for years I visited them, and I said, aren't you worried about him taking your business away? Oh no, it's a necessity. I said, that's all the more reason for him to take it away. And lo and behold, one year I visited them, it had been taken away from them. Completely taken away from them. They got small nominal compensation. There was nothing you could do to protest it. I mean, similarly, the same vein, they expropriated cement assets, grocery stores, and all kinds of stuff has gone on. So things the government deemed necessary. So think of the government of the country where you invest. All sorts of unusual things can happen. Again, even reasonable governments can do unreasonable things when it comes to political vote buying. The next thing really is industry structure. When you buy into an industry, and again, I'm not going to talk of the deep trench with water in it with crocodiles around the business, no, but some attention has to be given to the nature of the structure of the industry. Now why? Why am I saying this? Am I speaking on two sides of my mouth? Let me explain what I mean by this. What happens, we buy a business, when we buy a business, the way we buy a business, the business is typically quite depressed. Bad times have happened. And what you're there is you're going to buy this thing, you're going to buy it cheaply, and you're going to wait. And you're going to wait, and you're going to wait. You wait for 3 to 5 years. That's the sort of normal plan. After 3 to 5 years, you really would like to make more money. Yeah, I think that's a fair thing, because if you look at the arithmetic holding period returns, you'd like to over those years. So in the later part, you should expect to have some results for your investment. Now, that is most easily done when your business is such that as it comes out of the downturn, all the good things you assumed were happening, happen, and there's no change in the industry structure. So, which is to say, if there are 3 cement companies in a certain area, 2 cement companies in a certain area, and that's possible. We didn't have 4th and 5th and 6th one join the depressing the prices. So what you don't want is ease of entry into the business. You want, at least for a period of time, that there be some impediments. So the business, the number of players, increase of competitive intensity, does not happen very rapidly. Ultimately, in extremis, you could probably assume that competitive intensity does increase, particularly if it becomes a very profitable business. But ideally, what you don't want to see happen is early on, in your say 3 to 5 year period, that competitive intensity increases. Yeah? So that's how money is actually made, but towards the tail end of your holding period. And then, of course, industry shocks and macro shocks. We'll sort of talk about this a bit more in a little bit, but what do I mean by that? You know, sometimes some industries are prone to shocks. I mentioned earlier, shipping is kind of a horrible business. Steel is not a great business. How about another business which is particularly dire? Let's talk about airlines for a second. Airlines, I mean, look, they're very successful airlines in this country. I mean, we just saw about the public issuance of Indigo. We were reading about SpiceJet and taking over all those good things happening. But let's not forget, the airline industry is in general a horrible industry. Think of them as flying steamboats, just worse. I mean, you could relocate the steamboat, but this kind of steamboat, but it's a terribly cyclical industry. Sometimes, industries like this look very good. I'll give you a quick example. So, going back in the last decade, Brazil deregulated its airline industry. And like any developing country, yes, the distances are very large, so people would fly more and more and more. I mean, so you saw a huge boom. So everybody, there are 2 or 3 airlines, actually more than that, but these 3 principal airlines, all looked at these numbers, this booming, and of course everybody saw this huge, great, grand future. There's hundreds and hundreds of millions of people over there. So this thing is going to be great. So of course, everybody began the ordering spree. Remember, this is how all this always happens. Everybody looks at the same numbers, arrives at the same conclusion, and does the same thing. So everybody saw a rosy future, everybody ordered airplanes. Airplanes, historically, normally, are transacted in US dollars. If you may guess where I'm going with this story. So, to buy an airplane, a Brazilian company which earns revenue in Brazilian reais is buying a US dollar asset. They borrow in US dollars. So fast forward, this airplanes, all the deliveries are happening, the debt is building, then the economy falls apart. The economy has tumbled. Along with the economy tumbling, which of course results in fewer and fewer people flying, and the growth rate, of course, of customers falling way below the growth rate of the seats available to fly, which is, of course, empty seats to be filled, which is a terrible, terrible thing for an airline. But what's it? The debt to be serviced is in US dollars. And what else happens is the currency begins to fall. And the currency is down like, 38% this year, 40% this year alone. So you can imagine the revenue stream has fallen because of number, it has fallen because of currency, and so of course, this is a serious industry shock. Some industries are more prone to these kinds of shocks, I mean, to be clear. And debt, of course, augments the magnitude of the shock, and of course, the currency of your debt can add to it as well. So this is, it's something to always worry about. I mean, if you're looking for horror stories in Latin American airlines, there's a long history of airlines that have blown up in that part of the world. Long history. However, the flip side of that, which comes to the early attraction, is because the airlines in Latin America tend to come in, blow up, the number of survivors is very few. So survivors actually don't do that badly, as long as they can survive the next downturn. So for example, many of the airlines in the US that fly down there, the most profitable routes for them happen to be airlines, the Latin American routes. So, I mean, people have been attracted to this forever and a day, but it's not a fun place to be. Now, let's tackle the last leg of this thing. So, we talked about risk at the level of a company. What do we mean by avoid risk at the level of the portfolio? So, I think of it in very simple terms. Having too much of something. Now, what is too much of something? Now, this is where it becomes a matter of personal judgment and taste. Is 5% too much? Is 10% too much? Maybe, I don't know. I mean, these are very, very generic, so they're very individual kinds of things. But different people run their portfolios very differently. I mean, to be clear, I'm sure as you've heard about, a very, very wonderful fund manager bought a lot of a company and it became almost 30% of their portfolio, which was perhaps too much for me, but not too much for them. So it's a very individual thing. So I would not, what I would say there is the following. When you think of risk aggregation, there's a couple of comments on it. One, do not think of simple categories. So for example, there's a category in your portfolio that says insurance. We had many insurance companies. There was a point in time we had 15, 18% of the portfolio in insurance companies. The problem is the insurance companies operate in different countries. In Japan, in Norway, in Sweden, they operate in London, in the UK, and Bermuda. Very, very different companies. Very different regulatory environments, very different business dynamics. So to say that 15-18% of your portfolio is insurance and you have an enormous amount of aggregation risk would be erroneous. So get away from the standard classifications of how something is. Think in terms of what affects your business. What are the factors that affect your business? Would higher interest rates affect all these companies? Would higher inflation rates affect these companies? How would they affect them? So think rather across geographies and simple industry classifications when you think of how much risk you want to aggregate in your portfolio. Obviously, I mean, 20 and 30% in one stock is aggregation risk. Now, so that's one thing. I mean, again, this is again a judgmental kind of thing, and you should think of in those terms how different factors would affect the businesses. Leveraging of the portfolio. Well, I will confess to prejudice. I hate debt. Debt at the level of the companies I buy, and debt at the level of portfolio, and debt in general. I'm debt phobic. Now the problem with leveraging is it feels very, very good, and it is very, very rewarding when your stocks are going up. So you can turn a 10% rate of return to a 30% rate of return, which makes you look like a star. The only problem is if the stocks are falling. And that's really, I mean, again, everything I've said is what happens if things are getting bad. Okay, so that's my mantra is avoid situations where you get hurt by things getting bad on you. So avoiding leverage is, I think, an important thing. Is a very, very important thing. Leveraging basically can kill any long-term investment program. It can actually cause you to have to sell things at the worst point in time. You basically are cut out of an investment at the worst point in time, when you should actually buy more. Which leads me to my next, my corollary to that. Think about it slightly differently. Instead of thinking about leveraging the portfolio, why not have lots of cash in the portfolio? Why do I say that? So, the way we think about investing is we'll buy things that are cheap when they're cheap, and we'll wait. As I said at the outset, think of two pots. This is the cash to buy things, and this is the stocks. Buy if things are cheap, don't buy if things are cheap, which is another way of saying this, that you will probably hold cash at most times in your portfolio's life. That has, over the years, for me, proven to be a very, very handy thing to do. Because you never know when bad things are going to happen. For example, after 9/11, in the summer of 9/11, this is 2001, we wound up selling all kinds of things. Things got expensive, and we were sitting at 35% cash. When 9 September 11th happened in New York, suddenly, of course, it was a disaster. It was horrible, horrible stuff. It was a human disaster, and of course, the stock markets also collapsed. So we went from, within 2 weeks, after the markets reopened, maybe 3 weeks, we went from about 35% cash position down to 3%. So while you're willing to hold cash, do not be afraid to use it when the opportunities occur. Buying things cheap is a great thing. You just have to have cash to do it at the right time when things get cheap. So, holding cash, as I said, in the absence of opportunity is a rational thing. It's just simply good practice. It makes enormous sense to me. Typically, people in the world of traditional investment management think in terms of you've got to be fully invested. Well, I don't think so. What I do involves holding cash. That's what we do, more or less. The third item is make sure investors have the same objectives as yours. A story here. I started my first fund in 1996. It was a 1 or 2 person firm at that time, and it was word of mouth. And the most people I knew were in the financial services industry in New York. And so one person talked, another person talked, another people I hadn't known. And one of them wrote the footnote to his check, he gave the check, invested the fund, Amit's Emerging Markets Fund. I said, Dave, this is not an emerging markets fund. He said, you'll do emerging markets, I'm sure you will. You look like the kind of guy who's doing lots of emerging markets. I mean, I guess I know I'm Indian, but it doesn't mean I'm definitely going to do emerging markets. So it's a very strange kind of thing. So he expected me to do emerging markets, he also expected me to trade emerging markets. I said, Dave, I don't trade. I buy and I sit. You've got to trade. So he, of course, took his money back after some time because I neither bought enough emerging markets from him nor did I trade enough for him. So what you really do need is clients who know what you want, what you're doing, what you plan to do, what you want to do, and there has to be some alignment. This is especially true if you're a long-term investor. You want people who absolutely understand what you do, because otherwise, people come and people go. It can be quite terrible. It can be really terrible and extremely disruptive to any investment process that you have, which involves holding things for a long period of time. It can be very, very, very disruptive. And the disruptions happen at the worst point in time. For example, in 2008-9, when everybody was taking fright, all the people who said that they were long-term investors, they all took flight too. They all ran away. They took their money and off they went. So much the long-term investing talk went right out of the window. Oh, no, we need your money back now. So the kind of people you need are the people who, of course, understand what you're doing and are aligned with what you're doing. That I cannot tell you how important that is. And some very successful investors have over the years done that. One in particular comes to mind. Over the years, there's been a process of elimination of investors who are not aligned. Is a person by the name of Seth Klarman. Seth Klarman about us historically, if he doesn't have things to do and he has way too much cash, he would just return the cash to the investors. Just keep the cash. And because he knows the people will come back to him with cash if he reopens when things are cheap, historically. So if you cultivate your investors to the point that they are in sync with your thinking, that is how you will build a much bigger business, a better business, not just bigger, but a better quality business, really. And the last thing, I'm sorry, this is a very mysterious comment. Know the neighborhood you're going to. So, investing is about, in my case, because we invest around the world, and even if you don't invest around the world, you should think about where you are going. Now, what I mean by that, let me start by some 2 simple analogies to give you an idea. 30 years ago, I was in university in a class like this. That university was located in a very, very, very nasty part of town. It was really a tough part of town. I mean, let me give you a sense of how tough it was. So it's the University of Chicago. It's in the south side of Chicago, which in principle, historically was a nice area, but became a very, very tough and nasty area. In the state of Illinois, which is the state of Chicago is, the biggest police force, different areas have different police forces, right? So the biggest police force is that of the city of Chicago. The third largest police force is that of the state of Illinois. And the second largest police force was of the University of Chicago. So you can think, you just visualize, the neighborhood is wired. Every other block you had emergency phones. If you got attacked or if something happened to you, you would pick up the phone and call. A police car would be there rapidly. So you learned, because you study late at night and you probably walk into the library. I mean, you used to have buses to take you home from the library at night until the library closed. Bus every 20 minutes to take you back to your university residence. So you learn to look around to see what could creep up behind you and get you. The fear, more than nothing actually happened to me at all. I'm not sure, alas or happily, I'm not sure, but in general I think it was all hyped, excessively hyped. But so if you think about that in the context of investing, and this is not just thinking in terms of risks that can hurt you external to your portfolio, just like recurrent risks, government regulation, and all that sort of stuff. This is really more thinking in terms of, I don't want to call it tail risks, but like the big risks. The reason why I put this here is early on I found out in my career, when I started to invest, the first, professional investor of running a fund, started in late 96. By 97, late 97, third quarter of 97 and going to 98, we were right headlong to the Asian crisis. So as much as you could follow all the other principles up to here, in terms of safety of your capital, good balance sheet, good business, industry structure, everything, cheapness, lots of cash on the balance sheet. During the Asian crisis, anytime you bought something, it went straight down. And this went on for more than a year in reality. So it's a very painful kind of thing. We didn't lose money on a permanent basis at all. And ultimately, when you sit back and look at the numbers, the fund was down 9.5% during 1998, which was nothing compared to the 50s or 60s. Most people experienced having invested in Asia at that time. But still, doing it at that point in time, when everything you do is a bad trade, is a painful thing. So what do I mean by know the neighborhood you're going to? So let me just illustrate I'll give you two quick examples and I'll stop. First, late last year, about a year ago, oil crashed. The price of oil went from triple digits to mid double digits. And everybody said, oh my God, how can this happen? And an illuminated person like Howard Marks called it the failure of imagination. Now, perhaps, I'm tempted to say it was probably the failure of observation, actually. And so, would anybody have known that oil was going to crash? Well, I will tell you, this is not a sort of backhanded compliment to myself. We didn't know any of it. Why? So if you look around you, as I said, look around you, look where you're going. You saw enormous amounts of drilling going on in the US. Enormous amounts. Oil prices were up to 110, whatever the number was. They were up there. It made all sorts of things extremely, extremely profitable to do. Financing was readily available. In fact, so available that companies were so leveraged because they could not but make money. In fact, companies in those days had a hard time paying down their debt. So imagine the excess that was building. So you watch this with some kind of horror. You said, okay. And of course, the US is advertising the world, we are energy independent. We will become a big exporter. Okay, so far so good. That to me does not smell of shortages. That does not at all sound like we have a shortage in the making. We are plentifully supplied, and clearly we are heading for some kind of excess. What this is not, it is absolutely not a forecast of where oil is going and when it is going there. That's forecasting, we don't do that. But what this is, just looking around in the neighborhood, is to see, how does it feel? Does it make sense? Does it make sense to think of, will the oil companies be very profitable as they are today? But just the idea of that. So of course, the obvious thing happened. It was finally discovered in plentiful supply. It was adequately supplied because somebody was cutting back, and then somebody decided not to cut back anymore. So oil prices crashed. Could it have been foreseen? Probably, it was reasonably obvious. On the other hand, the timing and the extent were imponderables. Again, what people forgot is something that you hear these days in great quantity. The cure for low prices is low prices. Well, the cure for high prices is also high prices. I mean, so it's the mirror image of the same thing. So I think it's a bit asymmetric in terms of applying the same principle. The second example, and I will spare you more examples of this sort, because there are many stories of these sort of tail events. And by the way, oil, I think, is an interesting investment. I really at that point, it starts to get very interesting. So, going back, this is a much older one, a much older example, and it's an example on which we have dined for many years. It's an example which has over the years provided us with opportunities again and again and again and again. So, in 1999, I went to Buenos Aires in Argentina. What happened? There were some interesting companies there. Interesting companies both in terms of steel production, banks, there was an interesting agricultural company and so forth. Reasonably valued, good historical performance. And reasonably valued, good balance sheets. I mean, the management seemed right. It was all good. So it met all the usual criteria. All the checklist was a good checklist. It checked out all those things, and they were clearly ambitious, driven, and so forth. So you go to a city, you get to know a little bit about the city. You get to know first thing you see is the prices. And, oh my God, this is in 1999. A big difference. In 1999, it was more expensive than New York, London, or Paris. I said, I can't believe this. This is so outrageously expensive. We can hardly eat or drink here. I mean, this is absurdly priced. The people must be very rich here. Was my first line observation was the people must be very rich, comfortable, and so forth. So I said, well, how did this happen? I know it's an extreme resource-rich country. There's hydrocarbon resources which have been recently developed, agricultural resources. It's a highly educated country. So we look around some more. And what starts to become very interesting is people are actually being squeezed, and squeezed very badly. Why? You look at ties and belts in a store window. My Spanish in those days was terrible, it was non-existent. But what it said, you could buy a tie or a belt on an installment plan. Now, I think it's kind of interesting, like a belt, What would they do if they had to buy a suit? A suit would be outrageously expensive. You'd probably be drowning in debt for the rest of your life. And how would you ever pay for your suit? I said, that's kind of weird. So I had to go to the store, I had to ask them. And they said, oh no, you can use your credit card, we can layer that too, we can split that, your credit card payment out as well into many pieces. Well, I thought that's a kind of a weird thing. I thought, I suppose people are really being squeezed here. I said, that's interesting. Maybe Argentinians dress too much. They spend too much on clothing. I mean, they're very formal people, so they probably dress too much. So then the next thing where it started to get much more interesting was food. The diet there is very meat-centric. An Argentine would, and happily would, for 360, maybe 365 days of the year, eat meat. And they have spectacularly good meat by at least by most standards. But meat is also not that cheap. So what began to happen was, Argentina, just by way of historic artifact, had a lot of Italian immigrants, so there's a lot of Italian food there too. And so what happened was that they'd eat meat on every day of the month until they could afford it, and then the next day they would start eating pasta. Okay, so that day was called the gnocchi day. The gnocchi day was the day when you made the transition from eating meat to eating pasta until your next paycheck. Then you could start eating meat again until the next gnocchi day. So that was how it worked. That's interesting. But, again, maybe people are spending too much on meat, maybe. But the complaint of the people was the gnocchi day is moving up earlier and earlier and earlier in the month. I said, this is interesting. People are really being squeezed, not just in clothes, they're being squeezed on food. So, well, okay. The economic numbers, and I suppose we should look at it. So, the economy hadn't been doing much of anything other than because it was largely closed to society in some sense. The currency was extremely overvalued. At the time, it was $1 peso. One peso is equal to $1 by law. So, that per se is not a reason to freak out about this because Hong Kong has maintained a currency peg forever. The big difference is Hong Kong society, the labor force is much more adaptable. Argentina's labor force is highly unionized, highly inflexible, and highly politicized. So either, you have two choices here in this situation. And my conclusion was basically, one choice is you have labor market reform, people start to change work practices, and this becomes a highly productive country. And it had all the ingredients. It's a highly educated place. The second is if you can't do that, you devalue the currency. The problem with doing that is, because it was linked by law, by the Constitution, contracts had been drawn up in dollars. So banks had raised huge amounts of debt capital in dollars. Utilities like pipelines, power plants, transmission lines, all debt in dollars. And so if you sever the link, the revenue stream assets would be in pesos and the liabilities would be in dollars. The banking system would go bust like that. So I said, well, I'm not sure I can handle something like that happening. It's a horrible idea, it's a horrible thing. They would never do that. Failure of my imagination, clearly. I said, they might do that, but they wouldn't do that. It's too terrible to imagine. They'll blow up the entire banking system, there'll be no money. Literally, there'll be no money. Well, that's exactly what happened. I mean, we didn't buy any of the banks or any of that stuff. We actually did buy one company. It was an agricultural company. There was no debt at the balance sheet, cash. And if they devalued, the company would export more. We'd be fine. And basically there, when I said before, the utilities and all of them would earn revenues in pesos, this company, being an exporter, would earn revenues in dollars, which I would thought the assets therefore would dollarize already. Okay? So that was how it happened, literally happened in that case. And so check out the neighborhood where you go. Some terrible things to be looking at. By the same token, there can be some great opportunities. One happy thing, Malaysian plantations in the 2000s. Look at that. Odd numbers. Learn about the business. The assets are carried, the plantations carried are 1982 valuations. That was a good thing. Anyway, let me stop here. I've talked far too long. So, anybody? Questions, queries, disagreements?
Questions?
Sir. Disaster at the level of a company, at the level of an industry, or at an aggregate level. For example, the big capital markets crisis, like the global financial crisis, that will that's the first line of something popping up as an idea. Typically, or you could see some kind of change in an industry. Some kind of change happens in an industry that people seem not to understand or appreciate. Or another area, another way in which we've come across things is sometimes companies are embedded in corporate structures that people tend not to want to analyze. Sometimes you have to sit down with a sharp pencil and a piece of paper and lock yourself up in a room. Talk to nobody until you solve the puzzle. Think of it as a puzzle. And we're going to be very disciplined about it. And that has produced opportunities for us over the years. Usually it's achievements that comes first, but in terms of actual importance, the actual ordering of what causes rejection, it's usually the thing that causes rejection most of the time is the safety aspects.
Sir, you said you are macro myopic. At the same time, you are also saying you are macro aware.
Macro aware, yes.
I get confused.
Okay.
Both the things are.
Myopia is what I am in reality, very short-sighted. I can't see beyond my nose. I'm not going to read the slide over here. In that sense, macroeconomic variables, looking at them far away, forecasting them with any degree of accuracy and repeatedly, my ability to do that is zero. I'm totally unaware. So macro, unaware. Macro, myopia. Aware. What is the awareness in relation to? Each company, is a creature that lives not in isolation, but it is subject to factors outside it, macroeconomic factors, regulatory factors, governance factors, all sorts of things. So macro awareness is thinking about what kinds of factors influence a company's ability to make money, cause it to lose money, will cause terrible problems. There's something like Romeo, for example, the Brazilian Airlines borrowing in US dollars. That was a setup. It was a setup right there. Not that I had prejudices about the Brazilian real, when it was going to fall, if it was going to fall, but it is a risk. It's a risk that does not happen if the real should stay flat or even went up against the US dollar. It suddenly comes into focus when it goes down. The worst thing is it goes down at the same time when your ridership is going down. You know, when your business is going down and your debt hits. It's a number of things hitting at the same time. That was not forecast. None of this is a forecast. It's merely being aware of circumstances that could work against you. Which is very important. Which is very important to avoid problems. Sir? I apologize.
So I have two questions. One was you mentioned that one should keep a tab on the inept or the dishonest management. So when you're making an investment, do you personally meet the management? And if so, how is this challenge met by a retail investor who does not have access to management?
Okay, about meeting management. My views are ambivalent. There's pros and cons of meeting management. Some of the most successful management out there, the most marketing, promotional focused management. I'm not saying they're liars, they just inflate the truth. So, I'm sort of very wary about that. Now, sometimes meeting management is totally useless, not because they're dishonest. You can do all that work yourself on the desktop in New York, rather than be a Japanese insurance company. We can just do that work so easily in New York City. I don't want to see them. I mean, they'll take up 2 hours of my time, I learn nothing from them, they waste my time. So, on the other hand, there are other insurance companies that actually, because the reason that Japanese insurance companies is because their business is very standardized. They have automobile insurance, compulsory, voluntary, fire insurance, and marine insurance. These are all very standardized lines of business. They're very actuarially based, and they've been doing this for 100+ years. The thing there is, you can learn a lot in terms of how to reserve the loss experience, all that kind of stuff. That's easy to do. It's very easy to do. You can just do it on your desktop. That's useless. On the other hand, sometimes management's competence, and you say honesty, dishonesty, competence can be measured by learning how they deal with the different business lines. For example, not all insurance is quite standardized. For example, there can be very difficult lines of business, which are much more what I call human capital sensitive. For example, exotic lines of business. For example, nuclear reactor insurance. It's a small business with high disaster. I mean, low frequency of disasters, very high severity of disasters. How they reserve for its satellite insurance. I mean, there are these unusual one-off kinds of things. That's a different kind of business. It sometimes makes sense to do the people who do that kind of business. If there are people who are really good liars, I have no answer to that. I mean, it's hard. That's hard. I mean, out-and-out fraud is hard to detect. It's hard to detect.
And the second question was around, you mentioned that basically when you value a company, it's more around the liquidation. It's more around the liquidation aspect.
That's my preference, yes.
So when you're investing in service companies or companies which have high intangibles, how do you deal with that?
So, okay. There is a bias in this methodology that takes me towards, what do you call that? Towards asset-rich companies. Yeah, hard asset-rich companies. That's one. 2, sometimes, to the extent service revenues have an element of stability attached to them, have a recurrence attached to them, you can capitalize them, but you got to be very sure that they will repeat, and will continue. They're sort of locked in some fashion. You have to do this, otherwise something will happen. So the probability is you will continue to do it. Which is why service industries can be tricky from my perspective, unless there's some assets behind. You recall I referred to a securities brokerage firm, right? Investment banking firm. So the trick there was the following. The stockbroking business needs capital. If you close down the stockbroking business, you don't need that capital. So that capital becomes the property of the shareholders. That was where we got a big chunk of the tangible assets from. So sometimes service companies can get so cheap that you actually wind up with an asset-rich situation. Another example was a company we did a number of years ago, which was in the software business. It's a very weird software company. It's not the kind of company you expect in India, but what they did was they bought up people's dying contracts, service contracts. And what they did with those contracts was they put them together and they squeezed the costs out of them. So basically, it's your classic last puff from a cigarette or a cigar. Actually, the thing is they got 3 puffs of a cigar. Pay for 1, get 3. But the problem with that is you have to keep accumulating these things. I mean, people do change over time, so there's a certain churn that goes on. So, but in there too, you had the bulk of your value was in the tangible assets, but the service revenue, if you made a very conservative estimate and you paid 2 or 3 times earnings, which I think is not a bad number to pay for a software company, I think, 2 or 3 times earnings, you were well above the stock price. The thing that caused this opportunity was a big mess that happened after the Y2K episode. They invested so much and then the business never came. Of course, huge write-downs and there's a huge mess. So of course the company had cleaned itself up and that's how it became so cheap for us to buy it.
Thank you.
I have a question. Let me ask one question. We need to ask Amit.
Oh dear.
Amit, you follow the philosophy of primacy of balance sheet. That's the primary financial statement for you. But there is this concept called depreciation and obsolescence. And you think in terms of net asset value. So how do you incorporate these important concepts in your estimate of net asset values based on depreciations across different kinds of industry?
Well, there's accounting depreciation, is economic depreciation. That's the first thing. That alone has often provided us with terrific opportunities. So, for example, years ago, this actually goes back to the 1980s, mid-80s, there's a big tax shelter in the US. The tax shelters are actually huge sources of opportunity. Specifically, rail cars. Rail cars, you had a certain level of depreciation which would be applied for tax purposes. Very short life, and these things would last 40, 50, 60 years. So you can imagine you had something which was carried at 0 on the balance sheet and would be. So I mean, it's hard to, you have to have some sense of how old some assets are. You know, to have a sense of usable life. And that, I suppose, will feed into the actual valuation. I mean, and it is often reflected in the earnings streams of these assets. Case in point, oil rigs. Oil rigs in the early 2000s were cheap. What were really cheap were the oil rigs which came from the 70s and 80s. Now, oil rigs from the 70s and 80s had been around for about 30 years. So they had a pretty full life already, haven't depreciated completely. But so what you did with those, as opposed to the more recent generation oil rigs, which were the 3rd and 4th generation oil rigs, what you did was you used much lower operating earnings multiples. Why? Because it was an attempt to compensate for the risk that these older rigs would be subject to LIFO in terms of employment. They'd be the last ones that be employed, the first ones thrown out of employment once they. So you try to capture that and how you value these things. Does that?
No, it does. It does. I noticed you mentioned that you use multiple of operating earnings. Now you're using net asset value. How do you incorporate multiple of operating earnings?
So sometimes you use very low multiples. That's what you do. For example, in the case of a software company, 2 to 3 times operating earnings for a software company is, I think, a fine operating earnings number to use. I tend to be very shy about letting the numbers stray much about 5 or 6. It's not worth it. Most things come down to those prices anyway. So sometimes there are assets that don't generate operating earnings. Land, for example, is a perfect example of that sort of excess land and so forth. On the other hand, there are other assets that generate maybe stable streams of operating earnings, real estate, although I think that's a contentious issue. Simple multiples. Example, typically in Hong Kong, people use in a 3 to 5% cap rate. We, in evaluations of some Hong Kong real estate company, use 7 to 9%. I mean, we do tend to use lower multiples on average. Again, not that our buildings are older than their buildings, we just use lower multiples as a normal course of events. And also another example, this may actually come to that. So this company also has hotels. In hotels transact at what I would consider outrageous multiples, and 15, 16, and God knows, some huge number like that. But this company's hotels, and there, by the way, some very fine hotels. I'll name some. This company owns the Fullerton Hotel in Singapore, which is a very decent hotel. It's a very good hotel. They own part of the Conrad Hotel in Hong Kong, and they own part of the W Hotel in Sydney. And we've had that at 8 times earnings, which to us was at a very reasonable, given that it was less than half of what hotels are typically done. And not even more so for the ultra premium kind of hotels. And so we are trying to compensate for that leverage. Multiples are, it's not, we don't use what the comps, we just don't. Comps are for other people. You know.
So sir, my question pertains to the liquidation value of the firm. So the assets of the firm hold different value for different people. So we may have, for example, a hydropower company that has huge assets with high replacement cost, but we cannot sell those assets. So there's no market for these assets. So there can be opportunities where such companies are trading much below their asset value. But then how do you appraise such opportunities?
Okay. Let's see if I can give you an example similar to that, but it's not. It's a very imperfect comparison. Let me try this. So, the first big oil crash happened in 85, 86. Oil went from the 30s, 40s, it went down to the 6, 7, 15, whatever, some down farther. What happened was there were a number of oil rigs out there. A lot of people were drilling for oil because oil had gone up, and yeah, same stories now, but just in different prices. And a collection of oil rigs was caught out at sea. The people who owned the oil rigs could not afford to keep them going. And so the people who worked in the oil rigs had flown back. They couldn't even afford to bring their oil rigs back to the shore. So what are these rigs worth? Because these rigs actually did transact. They transacted and they were actually bought by a very well-known investor who bought the debt and blah, blah, blah. So it wound up as a part of actually a company which is called Ensco, which is a big offshore oil drilling company. So how did they value them? Well, they made the assumption, this is the assumption they made, that these rigs, you can think of them in two ways. One is, of course, you can melt these rigs down and sell them from scrap. That's one. Is that the best use? Probably not. But sometimes in cyclical businesses, you can get things below the price of scrap. For example, in the mid-70s, 74, 75, you could buy very large oil tankers for less than the metal value of the metal sitting inside them. It was huge oil tankers for $5 million, which is a fraction of what it costs to build on these things, and a fraction of what metal would be worth. And by the way, that was done by the Tish's. They were very successful, and that was extremely successful. So how did it work out? They bought it at the value of scrap, close to scrap, either directly or by the debt, for which this was collateral. So they owning the debt, they seized the collateral. Okay, that's how they own it. And how do they make money of it? Well, shipping, tankers, oil drilling, cyclical businesses, very deeply, profoundly cyclical businesses. And of course, these rigs came back into fashion. Now, ideally, we don't have to do anything we don't want to do. So we like something, an asset which actually has some use. So it's something that's a totally useless asset. We won't even think of that as an investment. We want something that has a prospective use. So that eliminates a number of kinds of assets. However, an asset that's temporarily unsaleable, unmarketable, out of favor, and unproductive, unrewarding, we look at it if it has a longer-term value to it. Does that answer your question, Karen? Yeah? Okay.
One last question.
Surely there's one last question.
I'll ask the last question.
Oh, okay. So I was hoping he would answer the question because he said he asked a difficult question.
I'm very curious. What do you think about the shipping industry at this point of time?
Depends which segment. So, mergers have begun to happen in the world of container shipping. There's clearly overcapacity, clearly there's fragmentation, and there's clearly a number of people who are other people who are involved. There's no question in my mind. There is some consolidation that has begun. I mean, the first big, very visible thing that you've seen happen right now is the merger, the purchase of Neptune NOL by CGM. There's another one that's very interesting that's happened. It's already happened. Hapag-Lloyd merged with a Chilean company. The balance sheet actually is not horrible. Now, to get to a good balance sheet, they had to do 4 or 5 rights issues, 1 a year for 5 years, which has been a long journey for the Chilean company. But if you have a decent fleet, there's going to be some serious attrition happening, really serious attrition. Is it time to buy? I have no idea. Again, I have seen this from thousands of miles of distance. I don't think Neptune is really a great company. I don't think, but others can disagree. Hapag may be a better company. Maersk has already signaled that the results are going to be horrible. So bad times are coming, so I suppose it merits a second look. But I think there's going to be some serious attrition because balance sheets are there's some really horrific. There's also not a supply of new ships. And these ships are usually bought with debt. Nobody writes a check for a ship. Nobody writes a check for anything, it seems to me.
Are there shipping companies with strong balance sheets?
I think this one maybe. It's certainly an area that we have some interest in, yes. There's no guarantee we'll find anything though. There's no guarantee we'll find anything whatsoever. I mean, there's, again, not all container shipping companies are alike. I mean, the size of ship, the mix of your ships is very, very, very important. Because that can limit the kind of ports that you can go to, the kind of money you can make. So it's very, very, very important. So the short answer is I don't know. But they are interesting. It is getting very interesting.
I think that's a great example of being macro myopic. I mean, he knows that this industry is not going to be obsoleted. I mean, we're going to be needing ships for a long, long time. I don't think you can transport things from A to B without actually physically transporting them. That's not going to go away. And that industry is going through a very bad period. The freight rates are at an all-time low, and they were at some point in time 10-year low, and then they became 15-year low, and then become 20-year low. So there's no way you can say where is the bottom. But I think what Amit is essentially hinting is that this is a good place to look for value for people like Amit who like asset-heavy businesses which are going through a lot of pain, and there could be a massive rebound in earnings if there is consolidation that takes place. And there, if you can find businesses which have strong balance sheets, a lot of staying power and a good management team in place, all you have to do is buy
and not crooks who run the companies, because many of these things are family controlled. Yeah. And sometimes they have a tendency to, when things get really bad and the balance sheet's really good, they take the company another cheap because people are really sick of these companies, take it off my hands, and they'll take it off your hands at a stupid price. And they become public again in the future. So yeah, I mean, there's no guarantee that I'll find anything, but the only thing I can tell you is I've seen mergers happening, I've seen all these companies suffering, I've seen the rates going down, and I've seen the stock prices going down. And that, I think, is some of the ingredients of what's kind of interesting here. Again, some industries, capital-intensive industries, are not prone to consolidation. This one is, and which is interesting.
Thank you so much.
Thank you for